Hey everyone, let's jump right into this. Today, we're decoding a really dense 24-page May 2026 SEC-style filing from Affle 3i Limited. Now, on the surface, I know it looks like your standard run-of-the-mill corporate paperwork, but hidden inside these audited sheets is a massive story of robust financial health and literally unprecedented insider confidence. Let's break it down.
Okay, let's dive into this. 1,100.38 crores. Yeah, you heard that right. That is the staggering bottom line right up front for today's explainer. And that massive figure brings us to the central mystery we're looking at today. Why is Affle's promoter group betting over 1,000 crores of their own capital right back into their own company? I mean, it's the ultimate skin-in-the-game move, right? We're going to look at the exact data that justifies it. All right, here's our roadmap. First, the 2026 earnings headline, then global consolidated growth, followed by a standalone results deep dive, the massive warrant issuance, and finally, key takeaways for investors. Number 2, unpacking global consolidated growth. Just to make sure we're all on the exact same page, let's quickly demystify some of the financial jargon in this filing. Consolidated basically refers to Affle's macro global footprint. Think all their subsidiaries stretching across places like Singapore, Brazil, Israel, and Japan. Standalone, on the other hand, refers strictly to the micro operations, just the core Indian parent entity. And honestly, the macro growth story here is brilliant. We are comparing the FY25 consolidated revenue of roughly 22.6 billion rupees against the newly audited FY26 figures. For FY26, they clocked in at over 27 billion rupees. It's just a massive global revenue jump year over year. But, revenue is really only vanity if it doesn't translate to actual profit, right? Well, for FY26, Affle's consolidated profit stands at a super robust 4,548.51 million rupees. This proves that their top-line global growth is actively and efficiently translating into a very healthy bottom line for the entire group. Moving on to Section 3, Standalone Results Deep Dive. Let's move to and see how this builds. Getting a clean breakdown of the FY26 standalone figures straight from the ledger, the core Indian operation generated revenue of 8,644.25 million rupees. Total expenses were kept in check right around 7,541 million, leaving a pure standalone profit of over 1,339 million rupees. What this tells us is that the Indian parent company isn't just relying on international subsidiaries to look good. It's actually highly profitable entirely on its own merit.
And the best part? You don't just have to take management's word for it. Walker Chandiok & Co. LLP, the independent auditors, officially state that these financials give a true and fair view in conformity with the recognition and measurement principles. These are strictly audited, clean numbers backed by an unmodified opinion, which provides immense reassurance to the investor base. Section 4, the massive warrant issuance. Okay, before we crunch the specific numbers of the deal, let's pause and define what a warrant actually is. Think of it as a financial instrument that gives the holder the right, but crucially, not the obligation, to buy shares at a fixed price at a later date. To secure this right, you make an upfront down payment. This is the exact financial mechanism Affle Holdings is utilizing here. Now, what's really interesting about this is the specific math behind the preferential issue. The board approved issuing 7.4 million warrants at a price of 1,487 rupees per warrant. But here is the kicker. The face value of a share is literally just 2 rupees. That means this 1,487 rupee price includes a massive 1,485 rupee premium. The total maximum amount they are committing to is that staggering 1,100.38 crores we discussed at the start, all structured with an 18-month tenure. So, how does 1,000 crore capital injection actually play out in reality? Well, it happens in a highly strategic sequence. Step 1, the proposed LOT has to pay a 25% upfront down payment right now to secure the warrants. Step 2, they hold this right for a period of up to 18 months. And then step 3, they pay the remaining 75% balance when they choose to actually convert those warrants into equity shares. It's a massive financial commitment, systematically structured over time. And here is the end result of that conversion. Pre-allotment, the promoter group holds 54.98% of the company. Post-allotment, assuming full conversion of the warrants, their shareholding jumps to 57.23%. That is a solid 2.25% bump in total ownership. The very people running the company are aggressively buying more of it at a steep premium. Finally, Section 5, Key takeaways for investors. So the crucial point is, how do all these pieces fit together? 1. Affle has a perfectly clean bill of health from independent auditors. 2. They've achieved massive consolidated revenue growth globally, crossing 27 billion rupees. 3. Their core standalone operations remain highly profitable. And 4. The capstone to the whole shebang? An unprecedented insider capital injection of up to 1,100 crores. And here is exactly why this matters for you. In the financial markets, you can have all the slick PR and rosy projections in the world, but nothing, and I mean absolutely nothing, signals true confidence quite like insiders putting their own personal capital on the line. Expanding their stake at a high premium is the ultimate signal of skin in the game. They aren't just managing the company, they are betting their own fortunes heavily on Affle's future success. Which leaves us with this final, fascinating question. With a massive 1,100 crore war chest soon to be at their disposal, combined with surging global revenues, what is Affle's next big strategic move in the consumer platform space? The financial foundation is clearly set, the promoters are entirely all in, and the next chapter is going to be incredibly exciting to watch unfold. Thanks for joining me on this explainer, and remember, always look at the data.